Number 3 of 7 of my common modern philosophies of investing is what I call the Boglehead Method. Okay. Now, again, as I've said before, these are my own little funny summaries of of how you would do things. These aren't official terms, but Boglehead is an official term, and Bogleheads are people who follow and just love the dude who started Vanguard, John Bogle, a Boglehead. And Vanguard is an investment firm, but Vanguard's philosophy was don't go and buy stocks on your own and all that stuff, and don't use mutual funds where you pay all these high fees. It's sort of like John Bogle and Warren Buffett got together and decided to tell everyone all you need to do is invest in the major market indexes, S&P 500 primarily, or maybe an all market fund, and do that as cheaply as possible. So originally they had mutual funds where the mutual fund manager doesn't have to do anything. All it says is they just mirror the market index and make sure they stay in balance with that. And so it's a very low cost mutual fund. When index funds exchange traded funds came on the scene, it's basically like a super easy, more liquid, flexible way to invest in a mutual fund. And they would basically do index ETFs. And the Bogle people, they're not all different from the Extreme Fire people, and they're save money, be prudent, be consistent in savings, dollar cost average over time into index funds. However, I think the Boglehead method, and it's probably one of the most common general methods, is that it wouldn't be an all stock portfolio. It would be probably some index funds of different market indexes or some international exposure. So maybe an S&P and some Russell 2000, maybe some Dow, and then maybe an international ETF of some kind, like European market index. And then it would have some sort of bond funds as well. And it would give you, what has historically been the common, thinking is you own stocks and bonds, and whatever age you are, that is the percentage of bonds you own. And that is how you have your asset allocation over time sort of stay in line with your risk tolerance of your age. So probably there's a bunch of Bogleheads that might watch this and go, that is completely not the Boglehead method, but it's what I call the Boglehead method. And this is my video, and I'm going to stick with it. But most financial advisors, you're going to go there and they're going to put you in a Boglehead method. They're going to put you in a combination of stocks and bonds, some domestic stock, international stock, some kind of bond exposure through ETFs. That's mostly how it's going to happen. And if you're doing a robo-advisor, that's exactly what's going to happen. You tell the robo-advisor, I'm 36 years old. I don't like to be very risky. I want to retire at 65. And the robot comes back and says, great, we're going to put you in 36% bonds through these ETFs and 64% stocks with some international exposure and some domestic exposure. There you go. So you could also maybe call the Boglehead method the robo-advisor method.